Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Welcome back to Cash Talk, and today I'm joined by JK. JK, how are you, mate?
Good, mate. How are you?
Yeah, not bad. Refreshed. Been away for, about 6 weeks. Had a little bit of jet lag on the way back, as you normally do, as you knew from earlier in the year. But ready and roaring and ready to get back into it because, it's a passion of mine doing this podcast, and I know there's a lot of people listening and watching, and I'm really thankful for that. So, shout out to all of you that are listening and watching to these podcasts. It's what keeps us going on these, and we're trying to give as much value as we can for you on your journey. So, JK, today we're going to be getting a little bit educational around kind of different investment structures, and what we mean by that is like what different kind of vehicles in a way you can invest in, and we're getting quite granular because we're not talking about like the actual do you put it in your name or you put it in someone else's name. We're talking about things like ETFs, LICs, managed funds, things like that, and what they are, what the differences are, and some of the things that we want to take into consideration. So, JK, we might just kind of get straight into it and start unpacking it. And the most common one, or the most probably one that was around for the longest period of time when it comes to investing in things like shares and bonds and stuff like that, is managed funds. And so explain to maybe those that are watching and listening, what's a managed fund?
Yeah, so it's essentially at its core, it's a unit trust that gets established by the fund manager. And then when all the different investors, it could be hundreds, it could be thousands, in some cases probably even millions with Vanguard and iShares and those sorts of fund managers. Essentially, the unit holders or the investors buy shares or units in these unit trusts, which is proportional to the investment that you put in. So if you put in, say, $100,000, you're going to have double the amount of units of someone, say, putting in $50,000.
Yeah, so it allows you to get like a small percentage of a big pie.
Correct, yeah.
Yeah, so, unit trusts are also very common, or, well, maybe not the word is very common, but somewhat common even in regards to business. Like unit trusts kind of act very similar, not exactly the same as like a company where you can buy shares in that company. And this is where we'll get onto LICs. But the unit trust has some certain things that it needs to do, this managed fund. And one of them is that, your entitlement is based on your units, correct?
Correct, yeah.
Yeah, and so when it comes to things like income, capital growth, that's also allocated at the unit holder rate, isn't it?
Yeah, so it's essentially proportional to your ownership in that trust. And for example, things like when there's income that gets distributed, that needs to get obviously declared and paid out to the unit holders. So you're essentially entitled to your proportional sort of ownership.
A lot of managed funds for a long period of time also were very much focused on active management. This would give you the ability for the fund manager to, take a position on, for example, a certain stock or take position on a certain index and take more of an active approach. And we still see that today in the portfolio management space, that a lot of managed funds are still in the active space. Yeah. Some are index-based and some are passive, if you want to kind of call it, but a lot are still in that active space, correct?
Yeah, spot on.
And both on the defensive side and both on the growth side as well too, especially in the bond market. Now, one of the common kind of brothers of a managed fund is ETFs. What's an ETF and how does it differ to a managed fund?
Yeah, so the easiest way to explain it, which is pretty much all it is it's just a managed fund that's listed on the stock exchange. So when it comes to, for example, things like buying and selling it, similar to when you go buy, I don't know, if you want to go buy CBA shares, for example, you just go on your brokerage account, you put in the stock sort of ticker. Each ETF has its own ticker or kind of code, and you can essentially just buy and sell units as you kind of please. Now, the big, I guess, advantage and why, they're becoming really popular and managed funds are sort of dying off a little bit is just because they are listed on the stock exchange, that ease to purchase and that ease to sort of sell. And then as well too, big one is sort of the liquidity as well.
So with it, when you talk about that difference in regards to like ease to buy and sell, can you see a difference, JK, maybe between a managed fund actually sometimes being advantageous, that it's less likely for it to be, how can I say it, so sensitive to market conditions?
Yeah, I think it's more the fact that I guess you're getting it valued every day, and most managed funds kind of do have daily unit values, but sometimes they're a couple of days delayed. When it comes to ETFs, you're getting that live market valuation pretty much every single day, exactly the same way that you get it as a stock.
So do you think there's both like it's bought easier, sold easier? One's kind of slower on the entry point. You got to fill out forms if you're not using a platform and all of that stuff, and then you got to sell using forms in the platform. Even when you use M funds, which are like M funds are like a managed fund that actually is somewhat like a hybrid between an ETF and a managed fund, if you want to kind of say that. But even that, like the process is a little bit harder.
Correct.
So what you're more saying is your observations have been that because you can buy quicker and you can sell quicker, the one is slower and slower, but overall it kind of washes out in the mud. Correct. Is that right?
Yeah, spot on. Yeah. And I suppose the other thing is too, because it is on the stock market, you're settling it in 2 days. So if you do want to rip out your money for whatever reason, you know that money is going to land in your account in 2 business days.
Yeah. And I would also say that there's probably more index-based ETFs than there is index-based managed funds.
We're starting to see a lot of active ones.
ETF.
Come on.
Yes, correct. And it's only to like, remember, fund managers, managed funds, ETF providers, whatever they may be, they get paid a percentage of your holdings. Yeah. And so they want to, their main objective from a revenue perspective for their business is to capture those volumes. Yeah. And they want to capture those inflows. So, you know, huge craze, crypto, you know, at once upon a time, obviously no managers in regards to crypto. Now more are coming into crypto. Yeah. It was very hard for you to get some kind of access to gold, you know, and then like the gold miners ETF came out, and then there's a gold. Like, so there's all these kind of, you know, the physical gold kind of ETF as well too. Like you're trying to get this access to these flows. And so, yeah, I think that there's going to continue to be a trend where there's going to be more saturation of fund managers at an ETF level. It's also gives them access to, you know, any platform that's got access to the ASX.
Correct.
Yeah.
Yeah.
Their cousin, not their kind of brother, listed investment companies, LICs.
Yeah.
So not as probably popular as their first cousin, but LICs, what are they, JK?
Yeah, so it's essentially, it works very similar to like that managed fund ETF kind of structure, but it's essentially a company. So instead of being a unit trust, it's a company, pays corporate sort of tax rate, and it's listed on the stock exchange, hence the name kind of LIC, listed investment company.
And that company owns the portfolio.
Correct, yeah.
Yeah, so you're buying into the company that owns the portfolio as well.
Correct.
And LICs, I would say, are typically active.
Correct, yeah.
Yeah, you're looking for that company that's owning that portfolio, managing that portfolio, and is trying to find what they call alpha. To give your portfolio a little bit of an edge. Yeah.
You can argue it's more of a business in a way.
Yes, you could argue it's more of a business than a way. And there's LICs. And there's a lot of advisors that do add LICs into their clients' portfolios. I think if you do, probably not to have it as the bulk or the core of your portfolio. We see these LICs, especially at an active level, maybe try to get like a small cap or a mid cap investment. You might introduce an LIC that's going to try and build that in. Or sometimes LICs on the defensive side of, as well too.
Other interesting thing about LICs too, which a lot of people don't know, is you can actually, if you take sort of the total assets minus liabilities in that LIC and then divide it by the number of shares available, that essentially equity per share can actually end up being less or more than what the actual share price is trading at, because it is a company. And it is based a little bit on sort of the supply and demand of whether investors think that LIC is going to be more demand, and sometimes it actually trades kind of more expensive or at a premium compared to what the actual underlying asset value is.
And why is that so important? So let's say the underlying asset value is worth 1 million. Mm-hmm. Yeah. But the valuation on the market is, say, 1.5. Mm-hmm. What's that telling you, JK, in layman's terms?
Yeah, it essentially means investors are willing to pay a premium to get access to that LIC because they think that, you know, the board of directors or whoever's in charge of this LIC is going to do a really good job. Or they have done a really good job, which is kind of increasing the demand for that share.
Yeah, so your risk is reduced the closer the underlying investments are
In a way, yeah.
to the market condition. Obviously, under that as well too can sometimes mean the opposite. It means that the market's saying, hey, listen, we might have some concerns.
Correct.
Yeah. So as much as you might be looking at it going cheap, for example, if you buy a house and the median house price is say $1 million, but these people are selling it for 600, it's so far off.
Correct.
Like, if it's too good to be true, something probably is lying there. But it doesn't mean that the market is telling the conditions right. Like there's been many cases that I've seen, and I'm sure you've seen, JK, where market's predicting something, it's putting that demand on that, driving the price up, and it's artificial.
Yeah.
You know, so we've got to be mindful of that.
And I suppose the other disadvantage with them too is, or I suppose something to be aware of is just the liquidity side of things, because it is with an ETF, for example, if there's not enough sellers on the market for an ETF at that trading day, the fund manager will just go and list more units. And then when they list more units, people buy them, they just go buy for more of the asset. But with the company, the shareholding's fixed. So you're relying on someone else being there to buy your portion if you want to sell it.
Get it. I know you've got a few things that you want to kind of talk about as well too in regards to these main three. Yeah.
So the biggest one is, I guess, around fees is a big one that comes up. ETFs are managed funds, especially if they're index-based, tend to be a lot less expensive compared to, say, LICs and those fees that you're going to see there.
And JK, in not all cases, but usually what I will see is that if they're promoting themselves to be more active, the fee is usually higher.
Yep.
And there's a few things that need to be taken into consideration when it comes to the fee. So usually you'll see like what they call an investment management fee, okay, and you'll see a percentage of that. But sometimes as well too, there's things like performance-based fees, isn't there, JK?
Yeah, correct.
And the performance-based fee is usually calculated. There's usually a benchmark that they're trying to hit. And then over that benchmark, they're then paid this performance-based fee. And sometimes, JK, it can be quite expensive, can't it?
Yeah, correct.
Yeah. And so when you're looking at this, sometimes when we're looking at this in a client's portfolio, we're weighing up around with all of these fees that are a hindrance to the performance of the fund. And then even if the fund exceeds the performance, is it worth it? And some people say, oh yeah, but if they're getting above that, I'm willing to pay that. But okay, cool. But what about if they're underperforming? Is there an underperformance discount? No, I haven't seen one. Yeah, so it's like, how does that work? So the fee is usually linked to the level of activeness on that account, but it doesn't necessarily all to be the case. I do also see that a lot of fund providers, especially in things like ASX 200 index-based ETFs, are really getting sharp on the pencil.
Yep.
And, they're doing it in a few ways. There's just so much volume coming in on those investments that they're willing to kind of drive the price down. But it's also they're trying to kind of get you aware of their brand and then kind of get other investments of that brand context. So it's like that, you're coming in for the Big Mac, but let's then give you the fries and whatnot as well too. So just to understand the dynamics as well.
Yeah, and I suppose that's something to be aware of for investors as well, is just with the flood of ETFs coming onto the market, it's very easy to go off and buy these. So it's just something to be aware of, just because something's easy and because it's the latest hype, just kind of, be careful what you're buying. And then it kind of goes back to our investment philosophy as well, which we'll talk about. It's
interesting, JK, as well too, like if you've got existing holdings, like you might have existing holdings with, let's just say, Vanguard, but then Beta Shares comes out with pretty much the exact same ETF, but it's like 0.01% less. Like you've got to look at, do I just throw more money at the existing holding just because it's there? Like there's this kind of like, And in a way, for me, I know there's like a limited risk in regards to this, especially in regards to like an index-based ETF, but I don't like all of my assets with the same holding. Like if I can find something that's got like the exact same characteristics or very, very similar, like 98% correlation, I might do that.
Yeah.
You know, I might grab an ASX 300 and complement it with an ASX 200. Not exactly the same, but playing a lot of the same game.
85, 90% of it's almost exactly the same.
Yeah, and I like seeing that, there might be a technology platform issue on one of my holdings, but it's not affected to the whole holding.
Yeah, correct.
Yeah.
I think like anything, especially once you get to a certain sort of net invested asset, it makes sense to sort of start looking at diversifying your fund managers a little bit too.
Yeah, I agree. Like there's probably a difference between having 5,000 in a holding to having 5 million in a holding, correct? Yeah, definitely.
Yeah.
What about things like tax, JK, and whatnot?
Yeah, so when it comes to tax, I suppose like I sort of mentioned earlier, LICs are paying tax at the company tax rate. You're sort of still getting franking credits associated with that. That's also net of the expenses inside that company. Similar to an ETF, more or less the same. You're getting the share of those dividends that are paid into that fund distributed to you for the financial year.
How does it work, JK, from a capital gains perspective on an LIC versus, like, for example, like a unit trust? Because, with a company doesn't get the capital gains.
Correct.
50% concession after 12 months. Like LICs are typical to kind of move things rapidly, but also if there's a holding in there for a long period of time, it is just a consideration that you do need to make.
Yeah, it may not be as tax effective. And like you sort of alluded to and we said before, LICs tend to be a bit more actively managed. And I suppose that makes it a little bit less of an issue because it's more of a business activity, like we said earlier, as opposed to like a passive investment structure where, we're holding assets for, I mean, in some cases, if it's an index fund, they're holding it indefinitely.
Yeah, a common question that I get asked is around, and you just touched on it before, but I just want to make this really clear, is do I get dividends from ETFs? Yeah, and for people that have been in it, you're probably laughing at this one, but for someone who hasn't invested before, some people have told them who may be a little bit older, invest in direct shares because those direct shares you get the dividends, and they've been given the wrong information around managed funds and ETFs. You do get that, don't you?
You do. You're essentially getting the dividend that was paid by the companies that are owned in that ETF or managed fund or whatever it is, and then that's just getting paid out to you. So some are going to pay more than others. For example, if you look at like an S&P 500 ETF. That's going to pay out less in dividends just because by and large US stocks generally don't pay as much dividends as Australian companies, for example.
There's a client that we work on where we do have direct holdings on, and we did that intentionally because we didn't want the manager to have the turnover on those funds, on those holdings. And this particularly was quite a larger portfolio, but we knew that we wanted high frank dividends and we wanted Australian assets. Yeah. And we knew that in this case, the banks were going to be that for this person.
And there was a specific income target we were trying to achieve.
And a specific income target. So you can see that, like, depending on the person's goals and depending on what we're trying to achieve for the person, we might introduce direct. We've got a series of managed funds in that portfolio. We've got a dynamic asset allocation as well too, with ETFs as well too, in an SMA, which is like a separately managed account. It's essentially a list of ETFs that's managed by, let's call it a consultant. Okay. But we did that with those holdings because we didn't want the turnover decision to be made by the managers. Because what you've got to be mindful of is, like, even in index ETFs, they're using an algorithm. Like, they're trying to track the ASX 300, for example, or the ASX 200. So when things are moving in and out, they move in and out, and you as the unit holder, you get the grunt of the capital gains. We wanted to control some of that.
Yeah.
And so the tax considerations at a granular level we look at, not necessarily when you're starting out that they're going to impact you then, but as time goes by and the portfolio swells, if you do the right job, it can be a big difference. Yeah.
correct.
I know the value of advice report, I think, puts tax element on getting it wrong versus getting it right at about 1.4% per annum.
Yeah.
So if you can kind of compound that over a period, that's huge.
Yeah, massive. Huge. And I suppose something to keep in mind with that example too is if we look at their direct holding as a proportion of their overall portfolio, it is still very small. It's just because it's such a larger portfolio we're working with.
Yeah, correct.
So again, it's not that we weren't moving away from diversification in that scenario either.
Yeah, correct. And we're probably adding to diversification. And so like diversification, we're talking, you can do it like asset level, you can do it like fund manager, like we're actually doing it in regards to the actual investment style as well, to diversifying the way that the method is used. But that was also, like we spoke about, income targets. We wanted to hold that. We didn't want that tax turnover as well, and to really reap the rewards of those franking credits.
Yeah.
And I think that's kind of the difference between professional investing and amateur investing. There's a lot more in amateur. There's a lot more hope. Whereas obviously we're trying to get that the certainty of the outcome for our clients.
Yeah. And the other thing that, going back to index funds, that a lot of people don't realize is that, let's say you're buying the top ASX 200 index fund, you're not buying the same amount in each of those 200 companies. So it's not the total value divided by 200 and that amount goes into each company. You've actually got the highest exposure to the largest company in Australia by market cap, or essentially value. And then your second biggest exposure is the second biggest company, and so on. And that takes away a bit of the work from the fund managers on why these are so cheap, because they don't have to constantly rebalance the portfolio. As one goes up in value, they need to trim it down so then it's the same value as the others.
Yeah. And then there is I haven't seen these a lot in people's accounts, but there's also equal weight
Correct.
ETFs. So that go against what JK said, they try and equally weight it. It kind of, just on a side topic, and this is where we're seeing both on the S&P 500 and even on the ASX, these kind of market caps on these top 5 holdings are going huge.
Massive.
Because these flows in these funds, if it be from 401ks or it's from superannuation or whatever it is. So, a lot of people argue that, a lot of the money's to be made, for example, in small caps and mid caps, but I think there's always this kind of risk and return, and I really believe, like from a core perspective, capturing that index over time, you're going to kind of do real well.
Especially if you've got a long-term view, I don't think there's really any concerns with that.
And if these top 5 drop off, then there's the new 5 that are screaming up the other way as well too. So, JK, we've talked about fees, we've talked about taxes, we've talked a little bit about liquidity and obviously the different kind of ways that they operate. Is there anything else that you wanted to add in there?
Yeah, I suppose how all of this ties into our investment philosophy and kind of what we do at Thriving Wealth. We probably find for a lot of our clients, like we mentioned earlier, we don't actually use a lot of LICs. I can maybe think of maybe 1 or 2 clients who have actually got them. And it's not to say that we don't like the structure. It's just more because we said earlier they tend to be more actively managed, and that doesn't really align with our investment philosophy.
And I think every advisor has a different approach. Our approach is to be making data-driven decisions for our clients and in line with their specific goals. And when we talk about active management, we're super active on the client's goals, the client's behaviors, the client's everything that we can kind of control. And what we can't control, and we don't pretend to control it. And I think what we're seeing with clients and the results we're having, and while I was away, every day I was getting these 5-star Google reviews, and it made me happy. And I think when I was like looking kind of from above, if that makes sense, and like looking and you're seeing these come through, it's really heartwarming to see the results that our clients are happening by listening. And these educational kind of podcasts that we have aren't just for our clients. It's for a lot of people that are, even they reach out to me and say, thank you very much. I have, other advisors that listen and watch these podcasts, or aspiring financial advisors as well. And, JK, you're a testimony of what I've taught you, and you're flourishing. May I see a back-to-back finalist position as well too in the Advisor of the Year. So, a holistic advisor of the year for the IFA. So good on you. But yeah, no, I think these, going back to these structures, I think these structures do work for some people. I think especially when you have a large net worth. Not to say that, these active managers, for example, or these LICs will ever be the core of what I'd be doing. But yeah, I can see if you're worth, I don't know, just going to throw a number, 20 mil, and you want to put $500,000 into an LIC that's active management, trying to get a little bit of alpha.
Yeah.
Is that really going to change your life? No. Yeah.
And I suppose the other thing to add there as well too is if you are worth 20 mil, and we have conversations with clients all the time about this, is what's more important? Is it trying to grow that 20 mil or is it just trying to preserve that 20 mil?
Yeah, correct.
And then sometimes you might use an active manager that's a little bit more, especially on the defensive side of the portfolio, that's a little bit more active, just to focus more on that capital preservation, that consistency, rather than just taking on risk for the sake of taking on risk.
Yeah, definitely. Don't take the risk you want to take, essentially. Take the risk you need to take.
Yeah, spot on.
All right, we might wrap it up there. Thanks, JK. But more importantly, thank you very much for listening to this podcast. And if you're loving these podcasts, make sure you like and subscribe on all major platforms and on YouTube and video channels as well too. And make sure you like and subscribe and send them to your friends as well. Thanks, and see you next episode. Cheers.
Thanks, guys.